Okay. So now let's try to see a complete example of a provision for bad debts wherein a company is existing on December 31st, year 5. The name of the company is Green Company, and they are going to change the method of bad debt recognition to aging of accounts receivable method, basically balance sheet approach. Previously, the Green Company used the percentage of sales method. They were using the direct percentage of sales method. Now the data available is like this. Allowance for uncollectible accounts was $15,000. Provision for uncollectible accounts during year 5, they have made a 2% of credit sales. So the credit sales were $800,000 and 2% of that was made a provision, which is the 16,000. And then they have written certain bad debts on 30th November year 5, which is for $13,500, and their estimated total uncollectible accounts as per aging is $18,000 at the end of the year. So at the end of the year, 18,000 is the total uncollectible accounts. Now we need to identify and do certain calculations. So first thing is we need to find what is our preliminary allowance balance. So we know our beginning balance was 15,000 here, as we can see within this question above. 15,000 was our opening balance of allowance. Then in year 5 we have created another provision for 16,000, which is here. So our total, I can say, number became, considering both of these number, as $31,000. Then what we have done, we have return of certain bad debts. Now these bad debts will always be reducing our allowance. So this 13,500 has been reduced from this 31,000. Then we can say our balance which is available within our I can say allowance account is 17,500 as of now. But as per aging report, we know that we need to maintain uncollectible accounts total of $18,000, right? So basically we know that at the end this balance should be 18,000, but we are having only 17,500 as of now. So what we need to do, we need to create a simply increase of provision. So $500 of provision will be increased here. Okay. Now in the year 2, what will happen? In, I can say, not year 2, actually step 2, year 5, how the bad debt expenses will look like. So you will say that our provision for uncollectible accounts was 16,000, which was in this year 5. Okay. So here you can say our original provision was 16,000, and then our additional provision which we created was $500. Why? Because this was missing here. This was not getting complete provision. So we have created this, and at the end we are having total bad debt expense of 16,500. So you can look this through account. Basically this was our account, and I can say this is our P&L account. Okay. So within P&L we know that we originally had $15,000 of provision, then we need to create $16,000. So we have created these $16,000 of provision from P&L, and then we knew that we need additional $500 as well. Why? Because of change of method, and based on change of method the final provision needed was 18,000. So we created this 500, and how this 500 will be created? This additional 500 is created from, I can say, our P&L account. So basically our total bad debt expense for that particular year through our P&L are 16,500, we can say. Okay. Now what general entries we need to pass for that? So the first general entry will be for write off of bad debts as on 30th of November, because we need to write off the bad debts. So when writing off the bad debt, we know that our accounts receivable will be reduced, so we are crediting it. And while write off doing, we always debit our allowance, because we are getting the money out of this allowance for uncollectible account, which is 13,500. Okay. Similarly, at the end of the year, we are also creating an allowance for this additional $500. So we will be passing an additional entry for that, and the additional entry will be like debiting the bad debt, because this bad debt will be charged to P&L and we need to debit that expense, and we are transferring that money to where? We are transferring that money to allowance for uncollectible accounts, which is our $500. So debiting the bad debt and transferring it to the allowance. So this was our next entry. Now the key points here to note is like switching to the aging method aligns the allowance method with the desired ending balance based on the age of receivables. So when we have switched to the method of allowance, then we have used, or I can say we have reached to the desired ending balance based upon this method. So you can see that our desired ending balance was 18,000, and based upon previous calculation it was reaching up to 17,500 only. So we have created additional $500 of allowance here. And the next thing is bad debt expense for the year is the periodic provision plus year end adjustment. So what was the bad debt expense? We saw that our periodic provision for this year, our periodic provision was $16,000, plus we have created additional $500 of bad debt. So our effective bad debt for that particular year was 16,500, which you can see that our bad debt expense for the year was periodic provision plus year end adjustment. So this was a example of I can say provision for bad debt, and before this as well we have done multiple practice questions. So I hope you understand this.